What is up, guys? My name is Nash and welcome back to another video. So today we're going to be talking about diversifying your portfolio. So it's really important that you have a diversified portfolio. This is going to help you when it comes to having a good return on your portfolio. So you always want to make sure that you diversify. So I'm going to start this from the beginning because I know a lot of people don't really understand when people say you need to diversify your portfolio, right? All right. So when it comes to risk, there are two sources of risk in the stock market. So you have your risk from general economic conditions. So this is going to include risk from the business cycle, from inflation, interest rates, and things like that. All right. So the thing is that you can't really predict these economic conditions 100%, right? So look at a couple of months ago when people were talking about the recession, they were saying we're about to be in a recession in a couple of months, but look at us now, we're not in a recession. You can't predict the exact date that it's going to be on, right? All right. So the point is that it's impossible to predict these economic conditions 100% because, the economy changes every day and it's affected by other economies too. So you're not going to be able to predict what's going to happen or how something is going to affect something else. You can take a guess and it doesn't mean that it's always going to be true. Sometimes you might be right, but most of the time you're going to be wrong. So that's the first type of risk that affects the stock market. And the second type of risk is going to be a firm specific risk. So when I say firm, I mean the company or the stock is the same thing. So the firm specific risk is going to be the type of risk that can only happen within the firm, right? Within the company. So let's use Microsoft as an example. When it comes to measuring Microsoft firm specific risk, we're going to look at their success in R&D, which is research and development. So this is when they're researching new products and then being able to develop those new products and then sell them to people. So that means that they're going to be getting more money, which is more money for them to reinvest into the company. So that's R&D. So their success in R&D is going to be one of the things that's used to measure the risk of their firm specific risk. And also you have management style. So you also have to look at Microsoft's management style. So this is going to be how management allocates capital, how they choose to invest their money. Are they going to pay dividends or are they going to reinvest 100% of the profits back into the business? And there's so many things that you'd have to look at, but those are some of the biggest things that you can use to measure the risk. All right. So let's say that we're only holding Microsoft in our portfolio and that's our only security in the portfolio. So we have 100% of our money in Microsoft, right? So what's going to happen if anything happens to Microsoft? So that simply means that with anything that happens to Microsoft, anything negative, your stock is going to go down because you don't have anything to protect you against risk. You have all your money in Microsoft. So if anything happens to the economy that affects the technology industry that Microsoft is in, that's going to affect your stock really bad simply because you don't have anything to hedge your risk when it comes to Microsoft. All right. So this is where diversification comes into play, right? All right. Let's say we add Exxon into the portfolio, right? So now you have two companies, Microsoft and Exxon. Let's say you choose to invest 50% of your capital into Microsoft and then the other 50 into Exxon, right? So now you have two stocks and your money is divided in half. All right. So without doing any calculations or anything like that, you'd know that your risk is less than what it was when you only had Microsoft, right? Because you have two companies, right? So here's the secret. So you want to pick two companies that are unrelated, right? So look at Microsoft. It's in the technology industry. And then you look at Exxon. It's in the oil and gas industry. All right. So because their firm specific risk is unrelated, that's going to reduce the risk of the entire portfolio because these are unrelated. All right. So for example, if oil prices fall, right? So this is going to hurt Exxon because they use oil. It's an oil company. It's oil and gas company. But on the opposite side, computer prices might go up. So that's going to benefit Microsoft. So these two things are unrelated. So if anything happens to oil, it doesn't mean it's going to affect the technology sector. So these two effects are offsetting, which kind of stabilizes your portfolio return. And the thing is, you can add as many stocks as you want or as many companies as you want. So the more unrelated stocks you add to your portfolio, that's going to result in less risk. It's going to take away that risk. All right. So the thing that you have to understand is that it's impossible to avoid all risk when it comes to the stock market, right? So you're always going to have risk, right? So risk, like I said before, is divided into two things. So you have your diversifiable risk, which is going to be this firm specific risk that you can diversify by picking unrelated stocks. After diversification, there's risk that still remains, and this is known as the market risk. So this is the risk that you can't get rid of. It's also known as a systematic risk or non-diversifiable risk. So this risk, you're not going to be able to get rid of it. So whenever you pick your stocks, make sure that you're picking stocks from different industries, because this is going to allow you to diversify the diversifiable risk. Yeah, guys. So let me know what you guys think about this in the comment section below. And also make sure to go ahead and follow me on Instagram, and make sure to like and subscribe. I'll see you guys on the next one.